Hello and welcome to a brand new show of Market Makers. My guest on the show today is Bhanu Baweja, Head of Research with the EM Strategy. He represents UBS. Bhanu, good to have you back on the team. Thank you for joining us.
Good to be here.
Let's first talk about the year 2013. When we started the year, Indian markets were trading at the top of the heap. Now we are trading at the bottom of the heap. Suddenly, we are not the good house in a bad neighborhood. What has changed?
Well, to begin with, I think many people are disillusioned with emerging markets in general. At the time of the crisis, or just after it, the received wisdom was that emerging markets was the place to be because this is the only place you're going to get real growth. And India is everybody's demographic darling as well, so it had a few additional attractions, domestic demand being one of them. But I think what many people missed at the time is that the slowdown in emerging markets is also structural. So last year, many people worried about Europe, and legitimately so. But the big news for me was how badly emerging markets growth performed. Not just in India, mind you. India was close to the 5 handle. Brazil grew at 1%. China, which everyone thought would grow at 9.5 to begin the year, grew at just about 7.58%. So the slowdown was universal, and I think the slowdown has been a structural one. I think many people are coming to that realization that without a strong developed world, emerging markets are not going to be able to grow very strong. This is a part of global rebalancing, which I think is a broader point, but I think this will mean that on a 3 to 5 year horizon, the emerging market slowdown is going to be structural.
So the brick has hit a wall.
Well, in a sense, what you can actually say is, I think what's more appropriate is that in 2007, when emerging markets were doing extremely well, that's the time they were on steroids, right? They had very clean balance sheets. They could lever up, coming back from the crises of the 1990s and the early 2000s. They could lever up, but they were trading into a global economy which was really growing at a much faster pace than it could have done or should have done, which we realized in 2008 when it all blew up.
Do you think it's too early to write an obituary for emerging markets?
This is not an obituary for emerging markets. There's still a lot of long-term hope in emerging markets, but I think we really must recognize that in the next 3 years, we are going through global rebalancing. A 15-year investor should celebrate this, saying that the growth in 2007 was imbalanced and unsustainable, and there has to be a give-back period where the developed markets deficits come in, where emerging markets as surpluses come in, and that is going to mean lower growth in emerging markets, and that's exactly what the world is rebalancing towards. Within emerging markets, there's a lot of rebalancing. China needs to slow down in its investment, needs to improve its consumption. India needs to do exactly the opposite. India needs to improve its investment and slow down its consumption. So there's still a lot of rebalancing within emerging markets that needs to take place. But at an aggregate level, the world is rebalancing. This is necessary give back for the kind of growth that we saw in 2003 to 2007. On a 2 year horizon, this might certainly mean that emerging market stocks, for instance, underperform developed market stocks because your balance sheets can be much better than Portugal, your balance sheets can be much better even than the US, but your income statement, which matters a lot for equities, for FX, are not decorrelated from the developed world at all. And most of the money that has come into emerging markets as a result of loose liquidity that you referred to earlier has actually gone in debt. And I think emerging markets debt can continue to outperform developed markets debt. I'm not that optimistic that emerging market equities on a 1 to 2 year view can do that.
What about developed market equities? Dow is moving from strength to strength. S&P is at a new all-time high. Look at the news flow which has surfaced up so far this year in Europe and in America. A poor unemployment data, chaos in Italy, horrible news flow from Cyprus, but developed markets and especially European equities, they're still holding on.
If I'm honest with you, it is hard to find value. It's a real struggle at this point to find great spots of value across the world. But this is, again, a natural corollary of a zero interest rate world. People get very excited when they say, oh, look, interest rates are zero and the opportunity cost of investing in everything is zero. Well, it's zero for a reason. There is no growth out there. So you can say that my discount factors are very, very attractive. But what about the numerator in that valuation multiple? What about the earnings growth, in other words, right? And how much of a valuation kick up are you likely to provide to the market? So it is difficult to find great value in equities. Where I agree with you more than anything else is Europe, because I think that if you look at the reaction of the fixed income market out there, Spanish government bonds are really not doing too much, Italian government bonds are not doing too much, and I think the news incrementally is getting worse. Not just because of an uncertain Italian election outcome, but also because I think what Cyprus tells us is that Draghi's hopes of a banking union followed by an economic union, followed in turn by the almost impossible fiscal union, are just that, they're hopes. The kind of hope that he emphasized last year when he said that he's going to do whatever it takes to fix the European problem was, today I'm doing this because there is greater willingness from European politicians to step together and move together. But today, a year later, you're telling us that a Cypriot euro is different from a German euro. That's not the basis on which a banking union is built. So, and when the very idea of a banking union is under threat, the question of a fiscal union does not arise. So your hopes really are that Europe grows out of this, and I think that that's a very fond hope, but not one I would put a very high probability on. So I think there's more turmoil out there. The US market, again, you're absolutely right. I think it's a fully valued market. It's the only place where you've actually seen growth delta. Again, you're not going to massive levels of growth, but the delta has been positive. You've seen that for the last 3 to 6 months. I think the news flow is going to sort of taper off, or the positive news flow is going to taper off in the next 3 to 6 months, at which point you could see that the US market also takes a bit of a breather, but I do think that the US is going to continue to outperform Europe and very likely emerging markets as well.
But bulls are of the view that global bond markets have seen a multi-year bull run. Now it's time to revisit equities.
See, I find that argument a little bit dangerous, if I may say so. And here's the reason. In an asset allocation perspective, fixed income gives you your hedge away from disasters, and equities give you your growth. They give you the optionality to move up. Fixed income is juiced out. When your hedge is juiced out, financial theory tells you take less risk. The argument, if I understand the spirit of your argument, it is that fixed income is juiced out, let's all go into equities. You're taking more risk, right? And that's a problem. It's a problem because you're not going into equities because you love equities, or you have conviction in equities. You're going into equities because you think your hedge is juiced out. That may not be the right reason. It can work for 3 months, it can work for 6 months, but T+1, T+2, there's a problem in equities as a result of that. So much as I think that fixed income in the developed markets is completely burnt up, I think you've seen most of the value being spent out there. I think fixed income in emerging markets probably offers you a slightly better alternative to equities everywhere.
Within the emerging market basket, what is your take on India? Are you overweight India? Are you underweight India?
I personally am quite worried about India. So within
economy and equities both?
Both the economy and equities, and I have been for some time. So let's understand the fundamental problem in India, right? Obviously, you have a current account deficit, and the deficit printed at 6.7 for the last quarter of the calendar year. It can perhaps get slightly better from out here. But consider this deficit is occurring at a time when investment has collapsed. In 9 cases out of 10, when investment comes off, the current account deficit improves. Because mathematically, the current account deficit is the savings investment gap. When investment slows down, your savings investment gap should go up, which means if it's a deficit, it should improve. It's a surplus, it should become a larger surplus. It's a very rare situation where investment slows down and your savings minus investment comes off, which essentially is when your savings rate declines more than the investment rate, right? You're in the August company of Ukraine when you're in a situation like that. And there's no other emerging market that's in a situation like that. So India's real problem is a decline in its savings rate, which is why I thought the budget and also the economic survey, which was a very good economic survey this time, you could see Ravi Ramrajan all over it. It was a great economic survey. Laid such great emphasis on how India needs to move away from physical savings, gold, or real estate, into financial savings, which actually can be used to finance investment, which it hasn't done so far, and in fact you've continued to go the other way. But some of the policies that the government has followed for the last 5 to 6 years are inherently inflationary, and that's one of the reasons the demand for physical savings as opposed to financial savings may be structural. You can impose 4% duties, and you can really clamp down on gold gold imports, and I think that will be effective in the short term, both in killing gold demand and also, more importantly, for the trade deficit in killing gold imports. But that's not going to sustain for the long haul, because people will find other ways of circumventing savings. You'll probably find in your balance of payments that errors and omissions begin to increase, or import bills begin to increase. People start billing more. So people will find other ways. What you have to address is inflation expectations, and that I'm not too optimistic about. Cyclically, inflation is going to slow down, but that's only because growth is in a really bad way.
Maybe the base effect.
And the base effect, of course, which is statistical, so we really can't discuss that in great detail. So yes, WPI is going to come off, but yes, CPI is going to come off. But let's take a step back and think about the numbers. CPI at 10.8%, WPI at about 6.8%, with growth between 4 to 5%. You're not in a good spot. So maybe if you think about the delta, perhaps growth improves just a squiggle from out here, inflation comes off just a little bit, and if that kind of delta excites you, then I guess you can be bullish. But I think you've got to take the bigger picture view that there's a problem of savings out here, because there's a problem of inflation expectations out here, and there's also lack of policy clarity, which has impacted quite independently to everything I've said in investment, the investment approval process, the investment decision-making process, and that's not likely to improve anytime soon when people are saying that I'm not going to invest much before the next election, so you're waiting for 2014, perhaps late 2013. The key question is, does everything automatically turn around after that and become better? But we've got to think harder about that.
So do you think Indian economy is currently stuck between rock and a hard surface? One side is capital formation, or new capital formation, which is not happening. On the other side, you got consumer, which is slowing down.
The consumer is slowing down, and that's especially a big worry for the markets. For me personally, because as you know very well, when you say that the stock market is trading at a price multiple of, pick a number, 13.5 to 14.5. In today's market, it makes very less sense to say that, because it's such a binary market. The divergence between different sectors of the market and their valuations is so extreme. What is the mean of 2 and 50,000? It doesn't make sense to have a mean of 2 such extreme numbers, because the standard deviation is so high. And that's kind of what you're seeing in the equity market today. There's some sectors that are trading very, very expensive, and there's some sectors that are trading quite cheap. And amongst the sectors, as you know, that are trading quite expensive is consumption, on this story that India is always going to continue to consume, because large population, middle income rising, and so on and so forth. But one of the most basic equations in economics tells you that consumption is a function of income. GDP growth has been coming off, incomes have been coming off, and therefore consumption is going to come off, and we are seeing that everywhere. So that's one sector that I am quite worried about, especially because it's a heavyweight sector, and there's a lot of passive money that has come into this market, and if that sector begins to disappoint, then I think people might cut some of their losses and run.
In general, what do you make of the government PSU drive, a disinvestment drive, the fact that Finance Minister has clearly indicated that he will manage the fiscal deficit?
We've been told that before. And as everyone knows, the risk with India is always execution. There have been a few positive things that have gone on, right? I mean, yes, the diesel price hike is positive. Yes, the de-emphasis on subsidies, or the emphasis on de-emphasizing subsidies, I should say, is positive. Yes, the fact that fiscal machines switched off, the expenditure machine switched off completely in the last 6 months, gives you a sense of the government's seriousness, the government's intent. But that's not sustainable. I mean, look what it's done to growth. And you've got an election coming. Realistically, it's a little difficult to expect that continuing. Obviously, the government is going to start spending. They said they're going to start spending starting April 1st, so I think we'll see that. I mean, the essential point is that on a positive note, the government has begun to de-emphasize non-plan expenditure and begun to emphasize plan expenditure and capital expenditure. That's much needed. But that's the kind of positive you think about on a 5 to 10 year horizon. That should not make you too bullish on the market right away. So yes, there are a few positive steps in the right direction. Yes, the government has completely acknowledged the situation, and if the economic surveys, any indication, have assessed it beautifully. But there's never been a dearth of good advice in India. It was not that they don't understand the problem. The problem is whether you're going to execute it well enough. Based on history, and perhaps I'm getting old and cynical, I'm not very optimistic that we meet the 3% target in 2017.
So when do you think real growth will come back for India?
I think it's going to be a long, long drag. We might be sitting at a cyclical trough, but only because the wind blows north of the South Pole. If that makes you optimistic, then that's fine. Again, that may be true on growth. That is not true on valuations in various sectors, because, as I said, the market is split between the expensive and the poor. When you look at the expensive sectors, or when you look at the fully valued sectors, as many people in the sell side like to call them, you'll find that earnings expectations are not too low. In fact, my sense is that for most sectors, earnings expectations are likely to come off, likely to be revised lower.
Do you see a situation that Indian markets in the next 2 years could get net outflows instead of inflows? Because in the last 2 years, you've got about $35 billion.
I mean, think about that number, right? $35 billion. We should put it in the proper context. Indonesia, which has outperformed in India by a huge margin, perhaps 15-20%. I'm not familiar with the exact number, but in that sort of ballpark, has got $3 billion since January of 2012. India's got 35. South Africa's got 1. Turkey's got about 2.5. India stands out in emerging markets in the amount of money it has received, and that's the problem. Even if your current account deficit improves, which it almost surely will from out here, if it goes from 6.7 to, let's say, 4.5, let's say even 4, the question is, are you going to continue to see that flow of portfolio investment? And not just portfolio investment. One thing that many people miss is that India's current account deficit, despite the 35 billion in equities, is actually debt financed. Because of all the money that comes into NRI accounts, because of all the ECB borrowing, all the bank borrowing, and if that flow slows, then you have a problem on the balance of payments. You know, to call it balance of payments crisis may be a little bit of an exaggeration, because the one thing the RBI has not done, it has not spent all of its reserves. In fact, its reserves are reasonably stable. They're going down, but they're reasonably stable. But make no mistake, reserves cover for short-term debt is falling. Imports cover is falling, right? I don't think there's a balance of payments crisis out here, but despite the fact that perhaps we've seen the worst in the fiscal, and perhaps we've seen the worst in the current account, I can't get too optimistic about the rupee at all.
Which means rupee could go back to 60?
Which certainly means it could go to 60, which you have to consider as a foreign investor. Because it's all fine and great to say that, look, my nominal earning growth is 12%. Right? And I frankly don't care whether it's inflation or real. But you do care, because for 3 periods, if it's all inflation and not real, then in the 4th period, the currency is going to fall out of the bed. And what really matters to you as a foreign investor is not nominal rupee earnings, but nominal dollar earnings. And nominal dollar earnings are going to be compromised if rupee goes to 60.
So how bad do you think we could see for Indian equities from these levels? A repeat of 2008 or a repeat of 2011?
Look, I mean, I think these comparisons are slightly flawed. I mean, I certainly think there's a possibility of downside of 10 to 20% out here, perhaps even more. The way I like to think about asset markets and asset allocation terms is, I like fixed income relative to equities. I have done for some time, and I would put that trade on today for the next 6 to 9 months. There are a few points that could make you wildly bullish on India over the next 3 to 5 years, but I think it's a little early to start playing those.
So what are those points?
Well, number one is Hill, right? If genuinely in a neutral or a good growth world, oil prices were to drop $20 to $30 to the barrel, I'm not talking about gas prices alone, I'm talking about oil prices, India is going to benefit more than anyone else I know, because that not fixes, but certainly addresses a very large part of both your fiscal and your current account deficits in one fell swoop. That's going to be very, very positive. And in fact, many people who are coming into India with that long-term view, so I can see that. The question is, what is the probability of that happening, and what's the time frame? And the biggest question for me is, what price is oil going to trade at? Right? Today, oil is probably one of the assets across all markets where you see a pretty significant, a pretty chunky risk premium. Because in most assets, you don't see a very high risk premium. I mean, I refuse to believe that the equity risk premium in the equity markets is very, very high. I mean, consider India, for instance. Is the bond yield going to go back to 3%? If you think that's a structural 3 to 4% bond yield is where it has to be, then the equity risk premium is quite high. But if you think it's about 6 to 7%, then it's not obvious that the equity market is horribly cheap. Right? Fixed income, I mean, you look globally with US rates trading at 1.7, 1.8%, where is the risk premium? So oil is one of the very few assets where there is a risk premium, so that risk premium can come off. The geopolitical situation in the Middle East doesn't argue for that in the near term. Supply from shale potentially can. But what is the marginal cost of production of shale oil? My understanding, and I'm not an oil expert, but my best understanding is that it's 90 to 95 today. So if you get waterless fracking techniques in the next 3 to 5 years, perhaps slightly longer, then perhaps the environmental cost and therefore the actual economic cost of oil production falls massively, and that's a very big bull argument for India. But that is one amongst several ducks you line under the banner of hope. Because you don't have that right now. That can happen, and by the way, it's completely exogenous to India. India has not worked hard for it, it's got nothing to do with it, but it would be like a gift from heaven for India if it were to happen. I'm not playing for that right now because I'm not convinced that shale oil today can be produced at a much lower cost. Perhaps there's a revolution in energy that's coming, perhaps that's going to happen in the next 3 to 5 years. I think we still have time to sit and assess that. I think far too many people are jumping the gun, getting seriously long India just because of that, because I think India's idiosyncratic, innate problems are imminent and probably much more worrying.
Before we wrap, a word on gold, because gold only does well when there is gloom and doom. If you're making a case that we should not ignore the problems in Europe, do you think gold could make a comeback in the second half?
Gold can make a comeback in the second half, but remember, if the US recovers, then gold prices are going to take it on the chin. If you're long gold, you're essentially short a US recovery, because gold is driven by a multitude of things. The chief amongst which is the 10-year US Treasury yield. So what is the opportunity cost of being invested in the US? If the opportunity cost of being invested in the US, the so-called risk-free rate, rises, then there is no reason for people to hold gold. And mind you, gold, copper have seen a 10-year secular bull run. I can't think of a better investment 10 years back than buying gold. That doesn't mean that it's going to be the best investment for the next 10 years. If you think the US recovers from out here, if you think that the US Treasury rate can go towards 3%, our forecast is 2.5, so it's not quite as extreme, but we are looking for US Treasury rates to move higher, then gold prices can be vulnerable, which does not in itself solve India's problems at all. It will be a marginal positive for the current account that the value of gold will fall. The question is, will the volume of import demand in India decline substantially or not? And I don't see that happening in a hurry. But I'm certainly not of the view that you should be very, very bullish on gold for the next 12 months from out here. Europe is a worry, but I think a bigger driver of gold is where the US 10-year goes, and gold does well when the US 10-year is declining. The US 10-year is already at 1.7%. So I don't think I'd like to be long gold, especially over the next 12 months.
On a lovely interaction, thank you for your wonderful and robust insights. Great to have you on the show.
Thanks. Good to be here.
Thank you so much.